5% mortgage rates are much closer than you think. No, seriously, they are much more closer than you think. So in today's video, I'm going to go through 5 changes that could potentially happen in 2025 that is going to bring interest rates down. Now remember, I mentioned 5 of them. Not all have to happen. There's 5 different changes that could happen, that might all happen, that would bring interest rates down. And there's 2 conversations that people are having right now, right, in the real estate market. And I'm going to talk real estate market in general for a moment because A, there's the residential market, the 1 to 4, you buy a primary, you buy investment, you buy a 2 to 4 unit, you know that market, right? Houses, condos. And the second market over here, which is a big one, which is the worst market, the slowest market, is the commercial market. Apartment buildings, you know, hotels, office buildings, all that. Well, you know the story there. If you've been in real estate, if you hear the news, it's like a depression. There's just not many deals. You know, that industry is down 70%, 90% in some markets. It's terrible. The reason why I say either there's 2 things that could happen, one or the other, because eventually one or the other has to happen, especially when it comes to the commercial market. And let me explain why. So the commercial market, most people lock in on a 5, a 7, a 10-year ARM. That means the rate after 5 years, 7 years, 10 years, it goes adjustable. And if that rate adjusts now, maybe they're locked in at 3, 4%, that rate could go to 6%, 7%, 8%. That's going to kill cash flow. That's going to kill valuations. That's going to kill the commercial market. The office market has already been crushed. And so if interest rates don't come down where people can refi and all these mortgages start coming due in the next 2-3 years, there's going to be a major issue in the commercial market, which could leak over to the residential market or cause a recession. Put a lot of pressure on banks, put a lot of pressure on our government to maybe have to bail banks out. Yeah, it's going to get real. So if rates don't come down to cure that problem, the second thing on this that could happen is prices will have to come down. So it's one or the other. So the experts I talk to, the biggest real estate investors I know, the economists, all that, they know it's either rates come down or prices are going to come down. And what's weird about now, if you take multifamily and a lot of the markets, some of the pricing has come down, but it hasn't come down enough to justify buy apartment with this rate and this cap rate. Don't get me wrong, some have, but there's markets like I'm in here in San Diego where it's like we're at a standoff. The rates are high, people aren't dropping their prices because a lot of the apartment buildings are on free and clear, or a lot of these people have still low rates. But this video I wanted to shoot is really about mortgage rates. It's not about residential or commercial. It's just about mortgage rates. And so today in this video, I'm going to talk about 5 things that can happen, as I mentioned before, that are going to affect mortgage rates and get us back down to 5%. Could the rates go lower? Absolutely. We just don't know what's ahead. We don't know if there's pain ahead. We don't know if there's a recession ahead. But I'm going to go through this. So if you're thinking about buying a house, if you're thinking about refinancing, you're going to want to watch this video. You're going to want to share this video with somebody else because I'm going to go through 5 things. And I'm going to tell you, there's a couple things in here that you have not heard most likely. If you follow me, you watch my stuff, you heard it. A lot of stuff people are not talking about. They're just talking about the main stuff that's out there. They're not digging down deep into some of the things that could happen to bring down and help out. And by the way, if we've never met, my name is Kenny Simpson. I focus on 1 to 4 unit financing. I appreciate you stopping by, checking me out, listening to my video. I've helped over 5,000 clients. I've been doing this 20 years. And whether you buy or purchase a 1 to 4 unit property, I can be your guy. Obviously, I shoot content on YouTube, on Instagram, so you should definitely go follow me. And here's my Instagram page right here. And you want to go follow me because if you want to get up to date of what's going on in the market, rates and content, and learn more about the housing market and the real estate market, I can be your guy. And so I create this videos, educate people, and that's how a lot of people find me. And hopefully that's how you found this video and you're learning more about the real estate market and what's happening and what does all this news really mean to affect interest rates, housing, and things like that. But today, this video is about interest rates. So we're going to dive in, go through these 5 things. And after, I'm hoping that will give you a lay of the land of what's really going on and give you some education, hopefully give you some confidence to see what is going to happen here over the next 10 more months of this year. What can we expect? And potentially, can we get those rates into the 5s? So number 1 out of 5, number 1 thing I want to talk about is the Fed's cutting rate. So most people think that when the Fed's cut rate, it brings down long-term rates. Historically, it doesn't bring long-term rates. It actually just kind of goes, they kind of go like, you know, they're just they're kind of going with each other. So the Feds last year cut 100 basis points, interest rates started coming down, and all of a sudden they shot up. So it did the opposite effect. Short-term rates where the Feds cut went like this, and long-term rates went up. So it did the opposite effect, and mortgage rates went back up. Yes, there's many reasons we can talk about it. It's the job market, it's the economy, it's inflation, all this stuff. But at the end of the day, we're going to talk about some of that stuff and how we're going to debunk or call it some of it BS, because really the data is delayed, and some of the stuff they're talking about that's causing interest rates to stay up might not necessarily be true. So number one, if the Fed continues to cut more rates, that means they know inflation's coming down, the economy's hurting, the consumer's slowing, whatever it may be. If they cut rates, that should bring rates down, because that means there's problems in the economy, or they feel like, hey, we're hitting our target inflation, the jobs market's slowing, the economy's slowing, the consumer's slowing. We need to drop rates that stimulates the economy, right? They talked about this year, they're going to cut 50 basis points. Well, what if they cut 100? That would definitely bring down interest rates and signal to the 10-year treasury that, hey, that's the one, that the 10-year treasury, that is what we follow in our industry. And that really, if that goes up or down, that really does dictate where rates end up. Number two, what can happen is the data changes. So right now, the Fed's stuck on, employment's really full. Yes, it's slowing down, but a lot of people have jobs. They're able to pay their bills. There's 160 some million people employed. So we're at full employment. People can pay their bills, whether you agree with that statement or not. That's how the Fed looks at it. And remember, we're talking about rates. We're talking about how they look at it in the market. And so the consumer's doing well. We're not seeing the consumers freeze spending. We're not seeing mass layoffs. We're not seeing, anything in the consumer as far as data to show there's a problem there. So there's nothing falling off a cliff, as we call it. So if data changes for the worse, that would signal to the Feds, we need to cut more, we need to cut faster, we need to cut now. That would signal to the 10-year treasury, hey, the things are getting worse. The number that's at 4.5 in the 10-year treasury as I shoot this video, that would come down to 4, 385, 350, and that would bring down long-term interest rates, which would be a 30-year fix, which most of you know and hear about. That is kind of the benchmark of rates that are talked about when it comes to residential housing. The third thing, which is I've been talking about a lot, is Fannie and Freddie. Those are the two largest lenders. I think they insure 70% of the mortgages that are done out there, 70%. There's been some talk out there because this administration is saying, hey, well, maybe we'll take it out under the government conservative and put it back in the private sector. It was in the private sector, privately owned. Obviously, the housing market crashed. If you didn't know, they took it over. They had to take it over, build it back up, fund it. And Fannie and Freddie is doing just well. It made 20 billion smackaroonies last year, which is a lot of money, the most it's made I think in a long time. And they did that with less volume than the refi boom. So let me repeat what I just said. They made more money and they had half the volume. What does that tell you? That means obviously, hey, they're doing well. The interest rates are higher. They're getting interest on their, money. And obviously the mortgage rates they're giving you are higher. So that means maybe they're charging you too much. I don't know. So when it comes to getting a mortgage, in the back end of a mortgage, we'll call it the margin. We'll call it what determines your rate. Determines your rate is, would you buy a house? Do you buy a condo? Do you put 5% down, 20% down, 30% down? Is it investment property? Is it 4 units? What's your credit? All these factors go in determining your interest rate. So when your factors are X or factors are Y, your interest rate could be 7%, and this one's 7.25%, this one's 7.5%. And there's many reasons. If you ever shop for a loan, or you ever refi or buy, you probably understand what I'm talking about. Those on the back end, those hits, we call them LLPAs, which in English stand for loan level price adjustments. And so with Fannie and Freddie, if they're making record profits, and the loan level price adjustments, there's a lot of them in there, they could bring those down. So let's just say they could say, you know what, rates are high. We need to come in here and help the American consumer out, the American homeowner out, whether you're going to buy or refi. And we're going to bring down those loan level price adjustments, maybe take some off, maybe ease them while rates are high. They could always take them off temporarily. They can put them back on temporary later. Look, they have some in there now that were done because of COVID. They never come back and change. They never said, oh, we should lower those, take those out. So they could come in here and maybe, bring down their interest rates right now, whatever you just call. If you got quoted 7% on a rate, they can maybe bring that rate down 3/8 or a half a point. Boom, right there. So that's another big ticket item that a lot of people don't talk about. That's low hanging fruit that we can get in there. There's actually people from our industry sending letters and notifying and meeting with the new administration about this and making them aware like, hey, we really need to fix this problem. So the fourth thing that I wanted to bring up was the spreads. I've talked about it tons on this channel. It's not talked about a lot. If you're in our industry, we know about it, but the general public, they don't know what it is. So let me just try to make this easy. There's a 30-year fixed mortgage, right? And then there's a 10-year treasury. You could go type in Google 10-year treasury, 30-year fixed mortgage, right? So just think of there's two products right here. The 30-year fixed mortgage and the 10-year treasury have a spread. There's a margin. There's a gap there. There's a number there that's between them. So the number can get smaller or larger, and that is called spread. The higher the spread goes, that means the market has more fear. There's more risk. They want to make more money. The lower it is, the more confident they're willing to lend and say, hey, let's push those rates down. Let's go, baby. Just like when we had the refi boom and the pandemic hit and rates were all time low, that spread was really low. So right now that spread has about a 0.75%, 75 basis points in it that could come down. That is, when you look historically over the last 50 years, it would sit at. So if the spread's at 230 right now, it could be at 1.6, 1.8. So let's just call it there's 75 basis points. So that means if you have a 30-year fixed mortgage, you're getting quoted 7%, you can get 75 basis points off. That means your rate could be 6.25. And if you go back to what I told you originally, that if the data comes in lower, right? If the feds look at data differently and they update their data models, if the feds start cutting rates, things like that, right? That interest rates could come down 3/8, half a point, thing like that, right? If they just lower, if the data comes out of the 10-year. Then I mentioned the LLPAs, there could be 3/8, 0.375 to 0.5% in there. So we start adding this up, you're like, wait a minute, Kenny, it sounds like if you're at 7%, we could be at 6% or 5.5% just based on these three factors. And I would say, absolutely, you're right. But remember, we have a fifth one. And the fifth one is the new administration came in and said, forget Powell, forget the economy, forget the data. Why don't we come in here as the new Treasury Secretary, Scott? He can come in here and say, why don't we buy mortgage-backed securities? And what that would do is they could manipulate the 10-year treasury and bring it down. They could do it temporarily. They could just say they're going to do it. So if they started buying mortgage-backed securities, they could bring the treasuries down. They could also say, to the market, issue other treasuries and things like that. So in English, what I mean is they can manipulate the rates down if they had to. They did this in COVID. They did this after the 2008 crash. So the feds, the treasury can manipulate the rates down. So they could say, the 10-year treasury at 4.5, we don't like it. We want to bring it down to 3.85 tomorrow, and they start buying it down. Boom, that would drop rates. So when we go through all these 5 scenarios, you've heard half a point, 3/8 here, 3/8 there. We're talking, if everything were to happen on this list, rates could go back down to 5% tomorrow. Like that. They really could. I know you're like, that doesn't make sense, because look, when the feds cut the first time last year, 50 basis points, the 10-year treasury dropped to about 350. There is people locking in with no points, 5.5, 5.625 and a 30-year fix. Today, that'd be almost 7%. And that remember, the spreads were still high. The LLPAs were still high. So there's a lot of room in here for the government, for the feds, for things to happen to bring rates down. And this is why I said I think we are much closer to 5% interest rates than you think. And the reason why I say this is because, look, the administration that's in here right now, they know there's the two scenarios, 2 stories. One story is, if we do not get the interest rates down, eventually we are going to have maybe a market crash, a commercial market crash, prices are going to come down, and they do not want that, because if real estate starts crashing or correcting at a big number across nationally, and there's a lot of issues, let's just say let's say the commercial more than the residential, that is not good for our economy. They don't want that. And they do know that the data is getting weaker. The job market's getting weaker. They do know that some of the factors that the feds use to calculate their inflation is actually old data. They use rents. So when you have PC or CPI, if you ever heard those numbers, just call them the inflation reports. In that inflation number, if you pay rent, they consider that rent expense. In those numbers, they're using rent data from a year ago. So if you've been living under a bridge or not in planet Earth, your rent, if you're a renter, if you own rental properties or anything, the rent you got a year ago, you either got on your rental property or you paid a year ago, are lower today. If you renegotiated your lease, you probably got it cheaper. And we're talking housing. So the feds in their model have old data. If they brought in the current rents today, they would be cutting rates. inflation would be down, interest rates would be down. So we know we are getting very, very close to this happening because the data, if they don't do anything or change their model, the data will catch up. So to end this video, how do we get to 5% interest rates? Look, it's going to be through the market data changing, things getting worse. It's going to be through the Fed saying, I'm getting nervous, I got to cut rates faster, which would signal and bring rates down, which would be the 10-year, the 30-year fix with the 10-year treasury, that's starting to shrink that margin. It could be through going into Fannie and Freddie and easing up some of these hits. When you go lock in your rate or buy a house or refi, they could bring the interest rates down. Or there could be the federal government comes in, buys mortgage-backed securities temporarily, whatever they need to do, brings the mortgage rates down to help the market. So folks, I hope this video helps. I hope you understand that we're getting very, very close to lower rates. So if you're sitting on the lines to refi and you have a 7% and you're waiting for the rate, keep waiting, keep watching. If you want to get on a rate watch, let us know. If number two, if you are going to buy a place and you're waiting for rates to come down, great, get ready, get pre-approved and get ready to rock and roll. But remember, depending on what market you're in, you should know that if you have low inventory, because everybody's locked in on super low interest rates that own houses now, you guys know that, the 2s, the 3s, the 4% rates that they're not moving. If you live in a market like here, San Diego, and rates drop and the inventory doesn't hit the market, you will be paying more for a house when rates go lower than you do now. It's just going to happen because we've seen it over and over again. So if I can help you, if I can answer any questions, please let me know. Thanks again for watching. Hey, I'd like to hear any comments you have below. Let me know. I'd love to hear your feedback. If you have any questions we can answer. Also, let me know. Do you think interest rates are going to go? Do you think any of these 5 things are going to happen? Do you think we're going to have interest rates in the 5s this year? And then secondly, share this video with somebody. Obviously, like and subscribe so you can get more of my videos as they come out. Again, thank you so much for watching. We'll be